Good morning, ladies and gentlemen. Well, another week passes, another week with the risk dial firmly in the green. If we have a look at what's happened, it just continues upwards, and the scores are all very close together. High 70s, low 70s, 80. There is not much difference here. The weekly models are still very much bullish. They are all closing in the 70s, and even the monthly model is trucking along. These moving averages are going to take a while to catch up, which tells me that we still have several months of risk on before we turn into risk off. No point in fighting it. It's going very well. Why fix something which isn't broken? However, big things are beginning to happen in the yield curve in the US, especially after Friday's job report, and it was a very thin session. The markets were hardly open, but some very significant levels are beginning to be traded. We are here in the 2s, 10s, and I'm beginning to think that this has shot its bolt. It's more likely to come back towards this 126, 127 support than to go up to the 178, 179 resistance. I'm probably going to start fighting this, looking for it to come back towards 126, and I will show you the reasons why next. Always with a proviso that Friday was very thin, and we need confirmation Monday, Tuesday. This is what is happening. It's very interesting. The 5s, 30s, well, we have held this 154, 155 area that's so important, and now we are busting through 140. We are likely to go to minus 124 basis points. That's the dotted line. You can see the resistance is there, but this is the direction of travel now. We are, and especially if we look at what's happened to the 10s, 30s. I got filled on Friday at 64 basis points. Very surprised. And this now gives me the resistance somewhere around here, around 57 to 56. This is a notable flattening of the 10s, 30s. The fact that the 10s, 30s are flattening tells me that all the pressure is going off the long bonds, and it's pivoting in the curve inside the 2s, 3s, 4s, 5s, 6s, 10s. That is the area that's getting hit, and we can best see that in the euro dollars. If that is the case, in that case, 2s, 10s, and 2s, 30s can really start flattening. As I showed you Friday, the pressure is now going on to the late 2023s and early 2024s. You can see the change. It's all U23, Z23, H24. That is where the pressure is going. If we have a look at the charts, you can see that we have absolutely broken these levels. We have broken the previous lows around 99.21, and it was a thin session, I have to say. We need the confirmation on Monday or Tuesday, but any rally back to 99.22, unless it's sustained above 99.25, 26, is going to basically give us I would say a target of at least this much on the downside, i.e. another 15-20 basis points down easily. Same thing in the September 23s, same thing in the December 23s. H24 is probably my favorite, and that is, you can see how we just cannot hold above 99.68 and a half or 99.68. That to me gives me a move of at least 20 basis points further on the downside. It's oversold. It was Friday. With that proviso, any kind of rally, and I think we go down. What is happening in the macro picture? We've decided that growth is coming forward, vaccinations are working, and that is going to basically normalize a very steep curve that we heard earlier. If that happens, all the pressure is going to go onto these Eurodollars that I mentioned, and the 5s and the 10s, and not the 30s anymore. If that is the case in the US, how far behind can Europe be? Well, it can be a year behind. But if you look at what's happening, the Fed is allowing rates to go slightly higher. It's allowed the long bond to normalize, and now the rest of the curve is beginning to normalize. The Bank of Japan is allowing a more flexible policy on the 10-year note, allowing it to go up slightly. If that is the worldwide trend, how far behind can Europe be? Who knows? A year, maybe two. But the direction of travel should be identical. I think opportunities are coming to Europe to finally see this curve go, from very negative to maybe even zero. And how will we know? This is the bubble. Very, very clear level here at minus 61 basis points. We start trading through there. We're going all the way to minus 52. That is going to be a very, very big move in the futures. If we look at the bunds, very, very clear here at minus 22, and God forbid minus 17. Minus 17, and we are in a completely new trading range. If I take that to a weekly chart, you can see how well basically we haven't been above minus 17 since God was a boy. We're talking about 2019. This could easily on the weekly be a bull flag, and that would give us an objective basically around 5 basis points. Those are big moves, considering that each 1 basis point in the futures is about 16 ticks. 1 basis point in yield is about 16 ticks in the futures. Do the maths yourself. If you're looking for 25 points, that is a lot of tick. That's over 300 ticks in the futures. So we can easily see some big moves coming up. My favorite would be actually the Italian 10-year bond, where we have some very, very clear levels. If you say that this is the bull flag, anything above, first of all, 77, 78, and then 82, 83 basis points, we are in clear skies, looking to target at least this level here, which is 97, 98 basis points. If we have a look on a spread to Germany, you can see, and I've showed you this chart the past couple of days, I tweeted it out. This is on a daily basis. Anything above 99 basis points, and we are going to 106, and God forbid after that we're going into 120s. If we change that to a monthly chart, we can see that, or even a weekly chart, probably clearer, you can see that we've been here for many, many weeks. And the risk reward is really very, very good. We're so close to the bottom. If it falls out the bottom, you know you're wrong. But I really think that we are going to go to 122 basis points at some stage over the course of the next 6 or 7 weeks. Now, the one chart that really has to move is the chart of, to allow all this to happen, is the chart of 10-year US against Germany. As you can see, we're very close to this resistance around 208. Could we come back a little bit and allow Europe to catch up? Absolutely, we could. We've gone a long, long way. We've done over 100 basis points in 9 months. So it's not so ridiculous to think that I might be right, and that the pressure after a week or so that it's gone onto the States, it might actually then go onto Europe, and European fixed income short of the futures in BTPs and in bonds is going to be quite a profitable trade to look at. If we look at the individual tenures in the US, you will see that I think I'm right. I think 5 years are now going to 116, 117 basis points. That's the next resistance. And if we have a look at the 10-year, it's holding in, but I think it's going to trade 185 basis points. That's going to be the attraction. And 30 years is the least problematic. As you can see, it held in wonderfully well last week. This 237 level, 240, it's basically going to be attracted to this 237, up, down a few basis points. But if we have a look at TLT, and I'll enlarge it, you can see that basically it's going to hug this 137 to 132 area with minor upticks back up to 140, basically spot on in my forecast for the past couple of weeks. Very pleased with it, made a ton of money. The pressure is definitely off the 30s, and I know how this works. I've seen it so many times. It goes in waves. They're then doing the 5s, the euro dollars, the 10s, and the 30s everyone forgets about for the time being. And I'm pretty convinced that the same thing is going to happen to Europe at some stage. Well, my nemesis, the DXY, the dollar, is really not doing that much, but it's still fairly bullish. The only saving grace is that it didn't close above 93.14, closed at 93, but that's really not much solace. It's holding this line. It's testing it from the underside. The 200-day moving average is still going down, but it looks increasingly more likely that it's going to test the 93.63 level, and through that we don't really have anything until we get to very close to 95. It looks like the pressure of the interest rate differentials is too great for the time being. I still don't think that it should be. I think that will change at some stage, and I will remain bearish of the dollar, especially for the second and third quarters. Doesn't mean I need to have a position until it gets to really good levels where the risk reward is overwhelming. At the moment, the risk reward is just not overwhelming, and I don't want to get into it. This is now the Euro USD, and as you can see, it held the 0.382 retracement of this whole move up, testing it again. Could it go down to this 115.25 area? Yeah, of course it could. But I think it's going to be. it's just, I just don't see what the attraction is in owning dollars over euros, because every time that the economic expansion has been global, and this should be a global economic expansion coming out of the pandemic, the euro has done and outperformed the US dollar by a lot. I still think that this is a false, breakdown to the breakout to the downside, and the overwhelming risk reward level is around the 115.26, or if you like, around these lows, which, as you can see, is just above 116. It's not a long way. I would prefer to play it via calls, and then we see. But I just don't see that being long of dollars is a smart play. Gold actually did slightly better than I thought it would last week. It's on a weekly, it's done some kind of a hammer doji or something. I don't think it's particularly significant. What I will be impressed by is if in this environment of higher, shorter term yields in any case, and a dollar which certainly is not looking imminently bearish, it breaks through 1764. If it does that, I will be impressed. At the moment, it's doing exactly what I said, i.e. 1764 high, 1658 lows, probably at some stage break and get everybody bearish, then rally. I can't see that gold is a chase, but I'm beginning to get less bearish of it simply because it's trading a bit better than I thought it would. On the other hand, is it doing anything spectacular? No, it's holding the weekly Bollingers on the downside. That's fine. I still think that we are likely to see lower levels. I think that this ABC down to at least around here, 1639, 1631 is more likely than not if you're patient. But I must emphasize that now a break and a weekly close above 1764, and I'll begin to ask myself why and be impressed. Onto the risk assets, which are doing nothing wrong. If we look at the shortest time frame, you have noticed that I will not fight this in any way apart from risking 3, 4, 5 ticks on some 1x2s. I don't think it's worth it. I think that a market which does nothing wrong, you leave alone. The very important level now becomes 39.74, and don't forget this is all INX, and the basis against ES is about 10, so you can reduce all these levels by 10 if you think in ES terms. Unless we start going down through there, it's still, it's broken out, it's going on its merry way. How far can it go on its merry way? Well, the dailies say not a long way, because we are at, around 40.20 is where the daily Bollinger comes in. I wouldn't be surprised if on Monday we get knocked back down into the 3000s as opposed to the 4000s. But that is just, that's just trading. There's nothing significant about it. If we look at the weekly, basically the weekly chart tells me that as long as you say above 38, 86, 87, there's really nothing to worry about here. Where's the top going to be? Well, next week it's going to be in the 40, 60s. in the Bollingers. So as long as the market does nothing wrong longer term or even in the shorter term time frames, why fight it? All I'm prepared to do is risk 3, 4, 5 ticks in some 1 by 2, and that's about it. If we look at the inverted commas reopening sectors like transports and the Dow, although they don't have anything for Monday because the cash market was closed, they're doing nothing wrong. They're just, holding their supports where they're supposed to hold and slowly grinding higher. I don't see that, there might be a little technical divergence that comes in and knocks it back, knocks this back down to 32,000, 600, 700. But that is just trading, and that is why I only risk, the 3 or 4 ticks. I see no signs that we are going to not trade, but that we are going to get some very deep and significant reversal signals. Let's put it this way, which basically means the downside is 1 to 2%, and that is then becomes a great buy level. While all that keeps on going on and we don't have leadership on the downside from any particularly significant sector like tech, and we've completely lost leadership in tech, and we can have a look at NQ. It closed above, in the futures, above 13,230. It's just doing nothing wrong. The fact that the yield curve flattened in the 10s, 30s helped it. These were great levels to pick it up, and we did. And these are probably great levels to get out. I mean, I got out far too soon, but that's me. Can we slowly fill this gap and then go up and fill the gap up here? Of course we can, but there is no more leadership in what is going on in tech, and without leadership in tech, I don't think we can go very far in terms of S&Ps, because let's face it, this reopening trade must be on its last legs, insofar as the wave, this wave goes. Everybody knows it's coming now. We've had the data. I just can't see where the value is at these levels. And if that's the case, I think that we are more likely to go sideways and then fill gaps than to get into a trend. The technology spreads tell me that we are very unlikely to have new highs in the Nasdaq anytime soon. Basically, all it's doing is going sideways, isn't it? Might it retest these moving averages, which are now rolling over very nicely? Yes, so what? But that is only like a couple of percent relative performance. For the Nasdaq, that is absolutely nothing. Can it do slightly better against XLF? Yeah, sure, but I don't think that we break this level anytime soon. And that's like, what is that? That's less than 1%, isn't it? Let's call it 1%. So basically what the spreads are saying is that technology is relatively stable within a couple of percent range against everything. And if and this is NDX over SPX, I can even enlarge it, and exactly the same picture as the Qs. So excuse me. So it's unlikely to be a leader, and that coupled with the fact that we are so late into the reopening trade, tells me that the upside in the S&Ps is, it's the grinding kind of trend rather than an impulsive trend which goes 10% in 2 weeks. I just can't see that. Is that view is confirmed for me by the deviations. As you can see, we're very close, or not, even into the red of S&Ps on the open on Monday. I just think that we probably do another one of these kind of things, a little bit, sort of sideways and a little bit higher than down. I just don't see the overwhelming value, even in the sectors. There's very little that can take us higher. The XLU certainly not going to do it. XLB, can the materials break to new highs? Okay, maybe they can, but that's only like 1% or so. XLK, as you can see, maybe it's got 2-3% of the upside, but that's about it. I think it goes sideways for a while. XLF, I think it's it's certainly still the one which looks the most likely to lead us higher. XLV certainly doesn't look like it, and that's a big sector. XLP has probably shot its bolt for a while. It needs to move sideways. So I really don't see. XLY potentially is the one, if Amazon gets gets going. It can certainly take us a little bit higher, but everything that I see talks about a 1% potential, a 2% potential for their overall index. Nothing that is going to be many percentage points, and a lot of things are overbought and they actually need to go sideways. So that is why I'm really not all that bullish, and I don't see huge value. I see value in buying the dips, but I don't see the value in chasing. I continue to see more value in Europe. This is EWU, which is the UK ETF. I still think that goes and trades above 38. Now, this is actually an interesting chart, which is the weekly chart of the DAX cash. I think we are very overbought. It's going to take its time, but I certainly see it testing this level up here, which is around the 16,000 level, just below the 16,000 level. And the one that is actually looking very interesting from a very long-term perspective is the stocks, which is breaking through 38.71, and it tells me that it's going to go and trade in the next couple of months at least to this kind of level, which is 4,000, 4,050, 4,080. That is interesting because it actually ties in with my idea that there could finally be a rotation in Europe. And I know am I ill? A rotation out of negative yielding bonds into something which actually makes you money. So if that happens, if those idiotic European institutions finally start seeing that the likelihood of appreciation in a negative yielding bond is zero, and they start selling them and actually investing that money into something productive like the stock market, we could see a real breakout in Europe. And you can see where we were. I mean, this is the year 2000. In the year 2000, we were at what 5,300. So, 21 years on, a whole generation has passed, and we are still 40% below the high. That's the kind of thing which could start really motoring if the Europeans finally get their act together. EM is doing nothing particularly right, but then it's doing absolutely nothing wrong. On a weekly basis, what have we done? We've come back, tested the 23.6 retracement of this whole move up, and we're holding it. And I keep on saying the level where you want it is between 52.08 and 50.23. That's where you want it for the longer term. I keep on selling those puts. I think selling puts is probably a better strategy than anything, because if we look at the EM spreads, and here it's against Japan, holding very steady, i.e. Japan, EM, very much the same thing. You're trading the same thing. It's going nowhere. It's retraced against Germany. It's retraced against Europe. And it's retraced against the US. But unless we start breaking, and that is because of the US dollar, but unless we start breaking this level, basically 0.13, I don't see that we are in trouble at all. It's still a sell puts market, and at some stage, and it's going to take a long time to develop, I think it's still going to be the market that will outperform. Europe at the moment should be the market that outperforms, and then slowly it'll turn and EM will be the market. For the time being, selling puts is probably by far the best strategy. Volatility is not giving us any huge warnings that the market is about to fall apart. We are quite happily trading in below the 20 range. Last week I said that we are likely to go down to the 1608 level. Looks like we will achieve it. I think that will be a great opportunity for tactical buys of volatility for returns to back up towards 22. That will be the panic high, 22.50, and then we return down to the 16s. If we have a look on a large daily basis, I don't think that we are very likely to trade much below the previous lows here, which are the 14s, 15s. I don't think that is likely to happen for a long time. Filling this gap here would be quite interesting. That's 15.53. We will probably get there, and that is as the market does this sideways and then dips down very quickly, 40-50 basis points, volatility spikes up and then collapses back down to new lows. I think that we are now in a 2022 down to 16-15 range in terms of VIX, and the futures will behave accordingly, not very different. So really the curve in futures is still going to get pressured. Finally, on to the summary sheet. 2s, 10s, I think they're going to start getting pressured. I'm looking for it to go back down towards the 127 support. I don't think 179 is achievable now. 5s, 30s, well, I've left this 140 because I don't know. Friday was such a thin day, such a nothing day. I don't know if we are really through it. If we are through it, 124 is the next level, which basically means that the pressure is onto the 5s and the 10s. 2s, 5s, 10s, euro dollars, I showed you, that is where the pressure is going to be. And I guess that is why DXY is doing what it's doing. It didn't close above 93.13, so 93.13, 93.14 is the level. But if it takes that out on a weekly basis, I think 95 is more likely than not. Gold, I've told you, I don't see much difference, but above 1764, I'm getting impressed, and I have to try to understand why. 39.74 and 39.50 in SPX are the levels of the buy the dip, and the weekly Bollingers are around 40.65 this week. So I showed you the daily we are going to open up at or through the daily Bollinger, which probably tells you that Monday, Tuesdays are slight retracement days towards this 39.74, 39.50 level, but I don't see anything significant. Support levels in Nasdaq. I think Nasdaq and SPX, as I showed you in the spread, now trade very much on a par. You know, one's going to go up 1% more than the other one day, back down 1% the next. I think they are tied together at the hip. Showed you that EEM is doing nothing wrong, but nothing particularly right. 55.83 is going to be big resistance, but as long as it keeps these levels, it's doing nothing really wrong. Now, the interesting market this week, I've put in the BTPs, the bunds, and the BTP bund spread. These are the very important levels, and I think doing something there is going to be very good risk reward, and I will tweet to you that on Monday. Thank you very much indeed. Have a wonderful Easter, and as I said, tweet you on Monday.